This is going to be the video summary of episode 12 of the ICT Mentorship 2022. Please, as always, refer to ICT original content. This is just a reminder for all of you that have gone through the mentorship and would like just a quick reminder. In this episode, we are going to be talking about market structure for precision technicians and advanced price action theory. Guys, I just want to remind you that this episode needs heavy rewatching and backtesting. We cannot learn everything that ICT is trying to teach us with this one episode, like in just one go or one watch. So prepare yourself, buckle yourself in, and just get patient and rewatch it a couple of times, okay? The biggest question of them all, is episode 12 the best and most important episode of the ICT Mentorship 2022? It's a great question, guys. It's a great question. Episode 12 answers the question, how do I know that the price will drop after touching an old high? Or, differently stated, if the price just crossed above an old high and I want to sell because I expect a drop, how do I know the price will not go higher? Those are very important questions, guys, and this episode is indeed probably one of the greatest of the ICT Mentorship 2022. ICT does not think or look at the market as, oh, the market is bullish, so the price will go up. But he thinks more in the sense of, does the market have a reason to go higher or to go lower? Or, just to state it more precisely, does the market have a reason to go higher to take out buy-side or sell-side liquidity? It's very important that we notice the question mark at the end. ICT is telling us to ask questions and to find the underlying reason for the price movements. For example, two possible reasons for the price to go higher are to take out buy-side liquidity or to rebalance a fair value gap. But it is on us to figure it out and to answer why that is a possibility and also why that is not the case, that is not the possibility in that specific time. Okay guys, now let's look at the Nasdaq E-mini futures for the contract of March 2022. These are the price movements that we have been observing in the past episodes as well. So you know that we find ourselves now at the end of February, beginning of March. The price did what we were actually expecting, as we have seen in previous episodes. We are not in the business of picking tops or bottoms, highs or lows. ICT tells us to keep looking and observing with an expectation, of course. We expect the market or the price to go higher or lower, but also willing to let the price move as it pleases and to take opportunities as soon as we can. We are now going to go into a deep dive of market structure in this area here in the red circle. So let's zoom in. Now we have zoomed in and we are on 1 hour time frame. We can see here, exactly as we have seen before, the higher end of the fair value gap with the red line and the lower end of the fair value gap. Now, to really get to know the underlying structure and so to be able to predict price movements precisely, we should understand the strength of an high or of a low. The strength of a high or of a low will always be connected to the temporal aspect of the price movement. So, the strength of a high or of a low will always be connected to time. Okay? So this is very important. ICT mentions it right at the beginning of episode 12. We need to understand highs and lows and their strength and then to rank them accordingly. ICT divides highs and lows in 3 different categories. We have, for the highs, the long-term highs, intermediate-term highs, and short-term highs. For the lows, we have long-term lows, intermediate-term lows, and short-term lows. ICT tells us that it is about the relationship and the connection of the different highs and the different lows. So guys, remember, only one high or only one low will tell us nothing. We need to look at the market structure and at the different highs and at the different lows as in relation to one another. And so we have to look at the whole picture. So we are on the Nasdaq E-mini futures for the contract of March 2022 on the 1 hour time frame. We see here the higher and the lower ends of our fair value gap that we have highlighted on the daily. Look at the red circle. ICT tells us that that high that we see in the red circle is actually a long-term high. So if we go back on the 1-day time frame, we are talking about this high in the red circle. You can see it here on the 1-day time frame. But why, guys? Why is this high a long-term high? Why do we classify it as such? This high is a long-term high because of the strength of the temporal formation. So this high, guys, is built on a 1-day time frame. We can see it there clearly, and it has a meaning on that time frame as well. For this reason, we will call it a long-term high. Now, after looking at the long-term high that we see now here in orange, what does the price do? The price starts going lower and it trades into the lower end of the fair value gap. You can see it here with the red dotted line. So this low in red is a long-term low. Now, guys, imagine that we are here and we just saw the price going lower. But we do not know what's going to happen next. So if you allow me, I have covered this part of the price movements. So the price is here. What do we do next? We go back to our expectations. So what were our expectations for that specific day and for the price movements? As we just had a long-term high forming, we do not expect the price to break above that high right away, okay? So if the price would do so, we would know that all of our expectations are somehow wrong. In that case, our analysis is also probably wrong. That said, guys, it can happen that we are wrong if we have already entered the trade because we believe the price would go lower and then the price somehow overtakes that long-term high. It's happened. It's the risk of doing this type of business. It is okay. That's one of the reasons why we have, and we should always know, how to manage our risks. So risk management is super important. Each one of us trades at its own risk. Not even ICT does it always 1000% of time correct. It's really more about managing our risks and taking our chances. Now, just to remind ourselves, we saw a bearish fair value gap forming on a daily, and all of the price movements so far have shown us that the price should go lower. The price indeed has stepped back into the fair value gap, touched the upper part of it, so the long-term high, and then it started going lower. And now it just touched the lower part of the fair value gap. After retouching the lower end of the fair value gap, the price finds support and it goes back up. The price comes near to the long-term high, but it never goes above it, okay? It stays below it, and we can see it here in the red circle. What does the price do after? The price consolidates. When the price is actually consolidating, retail traders looking at these price movements will believe that this is a bull flag, okay? They will believe that the price is about to go up and to go higher. I put here on the right side for us, guys, a frame, and inside the frame I have put what retail traders will probably see. So you can see the flagpole, the flag channel, the breakthrough, and then for them the price is supposed to go higher. But we are a little bit more clever than that, right, guys? Guys, remember that every single time the price rebalances an imbalance, so rebalances a fair value gap, for example, and we get, like here, a swing high, that swing high, that high will be labeled as intermediate term high. So this is the consolidation area. Let's zoom into it. So this is still the 1 hour time frame. This is just a zoom in, and I have highlighted here for us two swing highs. Okay, guys, let's look at the swings that the price is doing to rebalance the initial imbalance of the fair value gap. Every single time the price rebalances an imbalance and we get, like here, a swing high, that swing high will be labeled as intermediate term high. And also keep in mind the opposite is true. So every time the price rebalances an imbalance and we get a swing low, that swing low will be an intermediate term low. Now, guys, ICT also labels this high that you can see here with the semicircle as an intermediate term high. On both sides of this intermediate term high, we have short-term highs that are next to him, right? That are around him. Now guys, look at the big green candle, and next to it I've put a red arrow so that you can see it better. That is a big imbalance, okay? And anytime the price rebalances an imbalance, in this case by going lower and repainting over it, we label that low as an intermediate term low, and we have seen that before, right? Now guys, let's look at it in the opposite direction. Look at the big black candle here, and I signed it with a red arrow next to it so that you can see also its direction. This is a big imbalance, right? And anytime the price rebalances an imbalance, in this case by going higher and repainting over it, we label that high as an intermediate term high. Usually, intermediate term highs and intermediate term lows have at their side a shorter term, in our case high, as you can see here with the two red arrows. We can think about them as lower highs, or if we have an intermediate term low, as a lower low. The price is forming lower highs right next to intermediate term highs. It is very important to have always in mind the big picture, okay? The higher time frame. We can still see here the higher and the lower end of the fair value gap on the daily time frame. So those are our red lines, right? And we see that we are still inside them. We are still inside those lines. We are still inside the fair value gap. There is a concept of which ICT mentioned in this episode, which is time frame subordination. He says that the bulk of the orders, the bulk of the volume of the movement of a specific day, so for like the price to go up or to go low, so for people to buy or to sell, is coming in on a daily time frame. The smaller time frames will obey the order flow coming in on a daily volume. What does that mean, guys? That means that we will not see a lot of volume coming in on a 1 minute time frame, but on a daily we will see a lot of volume coming in sometimes. ICT talks about a hierarchy here, so it's very important to keep always in mind the daily time frame for that reason. Now guys, let's talk about intermediate term highs a bit more in depth. In this episode, ICT talks quite a lot about intermediate term highs. Intermediate term highs are quite important, and it's very important to understand them well to be able then to understand the market structure and what is going on. A high, and you probably have understood that already so far, to be classified as an intermediate term high can have one of the following. It can have either two short-term highs on each side of it, or it is an intermediate term high when it trades back up to rebalance an imbalance and it forms that high. Same but opposite applies to the intermediate term lows, so keep it in mind. Now guys, you know that I'm very keen on processing things, on classifying them and finding my own way to understand them. And so to show you, but also to myself, all the things that ICT tells about the intermediate term highs in this episode, I have made some scenarios, some let's say classifications of the intermediate term highs touched and talked about in this episode only. Okay guys, scenario 1, the ideal scenario. We have here an intermediate term high that has two lower highs on each one of its sides, okay? So you see a short-term high, an intermediate term high, and then a short-term high. This high is being called intermediate term high because it either has two short-term highs on its sides or because this high rebalances an imbalance. Guys, notice this. The two short-term highs next to the intermediate term high are lower of it, okay? So their level is lower. In this case, the market structure is preserved, and even more specifically, in this case that ICT is showing us here, the market is consolidating. Notice here, guys, with the two red arrows, that it looks like that the intermediate term high is indeed the top of that specific price movement, comprehensive of short-term high, intermediate term high, and short-term high again. So this is the ideal scenario. The intermediate term high is higher than the short-term highs. But it could happen that that's not the case. And guys, forgive my drawing skills here, it's just to give you an example and to give you an idea of something that ICT touches upon, but it's not actually shown in this episode. So he talks about an intermediate term high that has one lower high on its left side, but on its right side it actually has a shorter term high that is higher than the intermediate term high. In this case, the price did not respect the level of the intermediate term high, and the short term high after the intermediate term high actually went higher. And I call this and I label this as the disrespectful scenario, because the short term high after the intermediate term high somehow did not respect, right, the levels of the high before it. ICT tells us that if we see this happening, and for example, and we were thinking that the market should go lower, right, so that the price should go down, we would be wrong, as the price did not respect the level of the intermediate term high, which then it means that the market could actually be going higher later on. Doesn't have to, but it could happen. And this was the second scenario, the disrespectful scenario. Notice here, guys, that the arrow that we have and the price movement is going higher and higher. The price is forming higher highs. And this is the third scenario that ICT mentions here, which we indeed have within the price movements of this day. It is the weak market scenario, or better, I labeled it like that. We have an intermediate term high in red that has one higher high on its left and one lower high on its right. In this case, what we can see is that the market structure is weak. ICT tells us that in this specific case that we are seeing on the Nasdaq, it is a failed price swing, and ICT believes that an order block is coming right after it. Remember, that specific day we were bearish, so our expectation was for the price to go lower. The price is forming lower highs, and if we put an arrow on it, we can see that the price is going lower. It's a descending structure, it's a descending movement. Slide 47. So guys, again, forgive my bad drawing skills, this is just to have an idea and to make it simple. We have three scenarios that ICT talks about here regarding the intermediate term highs. We have the ideal scenario, in which the intermediate term high is on a higher level than the two short-term highs. We have the disrespectful scenario, in which the first short-term high is lower, the intermediate term high is higher than that, but then the third high formed, the short-term high, is actually higher than the intermediate term high. So the last short-term high did not respect the level of the intermediate term high. And then we have the third scenario, which is the weak market scenario, in which each high formed is lower and lower. We are on a 1 hour time frame, and we just zoomed in. So now we are going to go back to the last intermediate term high that we have here. We have here the intermediate term high in red that is actually rebalancing the previous imbalance, which we can see with the red arrow. On the right and on the left of the intermediate term high, we have two short-term highs. And actually, this intermediate term high is lower than the short-term high on its left. So the wall price structure is somehow going lower. Guys, remember that in an ideal scenario, this intermediate term high should have been above the two short highs on its sides, but it's not. If the short-term highs on its right was higher than the intermediate term high that is rebalancing this imbalance, probably our idea for the trade would have been wrong, right? But that's not the case here. So we can see with the red arrow that the price is going lower. And so what is it doing? Where it is actually likely to go? ICT tells us to look at the two candles circled in red with a big red arrow as well. he tells us that he is anticipating an order block right on or after these two green candles here. So now it's time for us to go on a lower time frame and see what is actually happening in here. So just to give you guys the full perspective, we are here still on the 1 hour time frame. And you can see here the whole price movement, starting with the long-term high, proceeding with the long-term low, and then with a series of intermediate-term highs and short-term highs on its sides. So we drop here on a 15 minutes time frame. And just to recap, guys, so that we are on the same page, we were on the daily, and on the daily we saw that the price formed a fair value gap and it tapped back into it. On the hourly, we saw that our expectations so far are confirmed, and there are signs that an order block is about to hit. We expect the price to go lower to the sell side liquidity, which we have signed here with the green line. It's always good to get a little bit of a general framework feeling while we are going towards lower time frames. Here, ICT asks us to pause the video for a moment and observe. Ask ourselves, what are we seeing? What are we observing? What's the price gonna go? What's the price gonna do next? And how can we profit from it? Right in the pink square, we can see a small little imbalance. ICT tells us that this is a fractal, an imbalance that is smaller than the previous one, but it is similar in its formation. Not identical, but similar. Let's focus now, guys, on the price range here in pink. In this pink square, we are going to be hunting for fair value gaps. We actually do not need to wait for the market to go lower first. And that's surprising, right? So guys, inside the pink square, we have two imbalances. The first one is the fractal, similar to the previous imbalance that got fulfilled. When that imbalance happens and it is fulfilled, we have our first entry here. Our second entry is on the second fair value gap that got formed in that pink square. We are looking for the price to go lower than the short-term low and then at the intermediate term low. When we have an intermediate term low taken out, we have a significant break in market structure. So when the intermediate term low is taken out, then we can go back to the previous range that goes from the long-term high to the long-term low, and then we use that range to know our take profit. So as we have done before, guys, remember we just project that range down. Or we can take our Fibonacci and use it to understand where our take profit will be. If you use the Fibonacci, remember that you should anchor it from the first intermediate term high to the long-term low. And ICT is going to explain us a little bit more why. So guys, if we decide to go with the Fibonacci, we should anchor it here on the first arrow until the second arrow that you see here. So from the first intermediate term high to the long-term low. And that is going to give you a projection that goes a little bit below the sell side liquidity. With Fibonacci, we use the intermediate term high until the long-term low. But why we are not using the long-term high instead? Because indeed it is higher than the intermediate term high. ICT tells us that that's because the decline in price starts actually with the intermediate term high not being able to go higher than the long-term high. So from the long-term high to the long-term low, we will have our framework. But from the intermediate term high to the long-term low, we will have our declining range. Guys, let me tell you again. From the long-term high to the long-term low, we will have our framework. But from the intermediate term high, so the first intermediate term high, until the long-term low, we will actually have our declining range. So guys, to give you a precise instruction of how to use the ICT Fibonacci settings, I'm gonna put here a link down in the description below to the Fibonacci video that I have so that you can put your settings exactly the same as ICT. And it's gonna be a different video from the one that I had actually uploaded before on the channel, because here ICT uses different settings, so be sure to check it out. Okay guys, so we are on our 50 minutes time frame and we are gonna go and zoom into the pink area here. So we have zoomed here and you can see a little bit more in details of the different candles that are bringing to that short-term high, after which there is a big decline. We have here 5 bullish candles, one after the other. We couldn't see them on the 1 hour time frame, but here on the 15 minutes time frame they're very visible. If we get then after those green candles a fair value gap, we do not need a swing low broken to actually enter the trade. We can have our aggressive short entry exactly where ICT is showing it to us without actually needing for a swing low to be taken. Guys, this is really interesting and really surprising because in the model that ICT is teaching, so far we needed a short-term low being broken and that signs our market structure shift, and then we need the price tapping back into that imbalance, and that would be our moment to actually enter the trade. But that's not the case here, and that's interesting. Here we do not need the short-term low to be broken before entering the trade. But why? ICT tells us that that's because we have a more nuanced understanding of the price movements. From the higher time frame, we told the different short and long-term highs and lows. We also have specific expectations that we are having all met here, and the intermediate term high is indeed not higher than the 2 short-term highs on its side, also gives us a big sign that the price is about to go lower. Guys, you know that I'm super happy that this also works in Forex because I'm trading Forex. And one thing that we need to keep in mind if we are trading Forex is that we should frame our ideas also looking at interest rate differentials. ICT will touch upon this in future episodes as well, and he's gonna also give us example. Just keep it in mind if you're trading Forex. Okay guys, we are on a 5 minutes time frame here, so from the 1 hour, from the 15 minutes we are going to the 5 minutes time frame here, and we can see even better and even with more precision within this pink box what is going on. Look at the order block in this pink box here. Notice the precision of these lines that are outlining the fair value gap. The precision is really incredible because the price is touching it, but without actually going above it. It's crazy. Really guys, I had to zoom in a little bit more because the precision of these lines, and you have it here outlined with the green and red line. So that's a fair value gap. It's crazy. That is the work of the algorithm. That is an order block. Here instead, where you see the big black arrow, the market is less precise, and ICT tells us that that's okay. It doesn't mean that it broke the pattern or something because it didn't completely repaint over the previous candles. It simply painted a little bit over the lines, and that sometimes can happen. ICT tells us that what's important is that when we see an imbalance getting rebalanced, the high formed as it rebalances it, that high should not be violated. And that's very, very important because that keeps our market structure in check and gives us a very clear sign that we are on the right path. Look at the black arrow. The price does not go above these candles. Yes, it touches them, but it does not violate them, right? It acts as a resistance. This is how ICT labels it: institutional order flow. Okay guys, so remember it's important. In price swings that are bearish, up closed candles are our resistance. In price swings that are bullish, down closed candles are our support. I want to take the main important lessons from this episode and just put them together in a couple of slides. So guys, highs and lows are subject to subordination. So some are more important than others. When we see an imbalance getting rebalanced, the high formed as it rebalances it, so that high should not be violated. If we blend that with institutional order flow, when we are bearish, all of our up-close candles should keep price from going higher than that. Now we know when our trade idea is right or wrong. We know when the price is respecting the expectation and when instead we should reevaluate. We know now when our bias for that day or week is correct and when it's not. That's crazy, like episode 12, guys. Mind blowing. In price swings that are bearish, up-closed candles are our resistance. In price swings that are bullish, down-closed candles are our support. Okay guys, we are back on a one-day time frame. Our big question is, okay, we have seen the price forming the fair value gap, tapping back into it, going lower, taking sell-side liquidity. What should happen next? What are our expectations about the price movements? In general, the price was bearish for a while. The price has gone lower as we expected, it took out sell-side liquidity, and now we are back above the sell-side liquidity. What does that mean for us, guys? What's next? ICT would suggest that at this point we do nothing, as the price is neutral right now. And if the price is neutral, it can be both bearish and bullish in the next days. So the best thing that we can do is preserve our capital, wait, and do nothing. If we do not know something, we simply do not know and we cannot be sure. We need to let the price speak to us and tell us the story. And right now, it's not talking, it's taking a break. Remember guys, more examples from ICT are coming in the next episode. Do not think that we need to learn everything right now and that everything needs to make sense, because that's not the case. We can take it easy and learn one thing at a time. Keep going guys, do not give up. This is the way. Guys, thank you so much for watching this episode with me. As always, remember that the additional material and the slides for this episode, as for all the other episodes covered in the Mentorship 2022 from ICT, are available to you for free. You can use the link in the description below to download them for free and enjoy. When you are really in doubt, let the doubt be your guide. Guys, that's a citation from my mom, but I found it so useful through the years. When you feel that something is not resonating, not convincing you, not making sense 1000%, let the doubt be your guide. Take more time, do not decide right away, and wait for it to show you its real face.